Let's begin with the concept of independence. The auditor should have independence of mind, actual independence, and independence of appearance. Both are required. We need to deal with independence for individuals within the CPA firm and for the firm as a whole. Not all individuals need to be independent, but the firm must be independent to perform attest services. To start, we need to define what is a covered member, as in certain circumstances, only covered members are considered not independent. Covered members are staff working on the attest engagement, an individual who may influence the attest engagement, a partner in the office in which the partner in charge of the attest engagement primarily practices, partners or managers that provide a specified amount of non-attest services to the client, the public accounting firm and its employee benefit plan, and any entity controlled by one or more of the above. There are independence requirements for all partners and staff. No partner or professional employee may own more than 5% of an attest client's outstanding equity securities. Combination of all such persons must also be at 5% or below. No partner or professional employee may be a director, officer, employee, promoter, trustee, etc. of a client. All direct financial interests are prohibited, regardless of amount. Oh, that means all. And material indirect financial interests are also prohibited, but only material indirect financial interest. The immediate family, spouse, spousal equivalent, or dependent of a covered member must comply with the independence rules unless the member is not in a key position. The individual accountant and the firm independence is impaired if an individual on the audit team has a close relative, parent, sibling, or non-dependent child, who has a key position with the client or has a material financial interest of which the accountant has knowledge. In regard to other relatives and friends, independence is only impaired when a reasonable person, aware of all relevant facts relating to the situation, would conclude that there is an unacceptable threat to independence. Let's go over some concept check questions relating to the independence issue. The firm of McGraw & West CPAs has two offices, one in Phoenix and one in San Diego. The firm has audited the Cameron Corporation out of its Phoenix office for the past 5 years. Mary McGraw, a partner in the San Diego office, married Bill Smith, the treasurer for Cameron Corporation. During the week, McGraw still lives in San Diego and works in that office, while Bill Smith lives in Phoenix working for Cameron. Mary does not participate in the engagement. Is Mary independent? Is the firm McGraw & West CPAs independent? Mary McGraw's independence is impaired because the independence rule requires that an employee not be an officer in an attest client, and because immediate family members, in this case her husband, ordinarily have the same requirements as the CPA. The firm's independence is not impaired because McGraw is not a covered member. Same circumstances. The firm of McGraw and West CPAs has 2 offices, one in Phoenix and one in San Diego. The firm has audited the Cameron Corporation out of its Phoenix office for the past 5 years. Jim West is the father of Will West, a Phoenix partner. Jim West has a material investment in Cameron. Will West is unaware of his father's investment, but does participate in the engagement. Is Will West independent? Is the firm McGraw and West CPAs independent? Neither Will West nor the firm's independence is impaired because Will West is unaware of the investment. Note, however, that if Will West becomes aware of his father's investment, he should not participate in the engagement. The firm of McGraw and West CPAs has 2 offices, one in Phoenix and one in San Diego. The firm has audited the Cameron Corporation out of its Phoenix office for the past 5 years. Bill Johnson, a senior in the San Diego office, has a material investment in the capital stock of Cameron. He does not participate in the engagement. Is Bill Johnson independent? Is the firm McGraw and West CPAs independent? Johnson's independence is impaired because of the investment. Because he is not a covered member, firm independence is not impaired unless that investment is more than 5% of the client's outstanding equity securities or other ownership interest. Once again, we have a question about the firm McGraw and West. The firm of McGraw and West CPAs has 2 offices, one in Phoenix and one in San Diego. The firm has audited the Cameron Corporation out of its Phoenix office for the past 5 years. Sandra Steverson, a staff assistant in the Phoenix office, works on the Cameron audit. Her uncle works as the chief accounting officer for Cameron. Is Sandra independent? Is the firm McGraw and West CPAs independent? Independence is not normally impaired by other relatives. Accordingly, since uncles are not included as close relatives, independence is not specifically impaired. However, that independence may be impaired in circumstances that would lead a reasonable person to question the CPA's independence. Accordingly, the Phoenix office should consider assigning Steverson to other audits. The firm of McGraw and West CPAs has 2 offices, one in Phoenix and one in San Diego. The firm has audited the Cameron Corporation out of its Phoenix office for the past 5 years. Bill Adams, a senior in the Phoenix office, does not work on the Cameron audit, but owns 9% of Cameron's outstanding equity common stock. Is Bill Adams independent? Is the firm McGraw and West CPAs independent? The independence rule requires that no more than 5% of the client's outstanding equity can be owned by all members of the CPA firm. Accordingly, both Bill Adams and McGraw and West firm are not independent. The firm of McGraw and West CPAs has 2 offices, one in Phoenix and one in San Diego. The firm has audited the Cameron Corporation out of its Phoenix office for the past 5 years. Johnson, a partner in the Phoenix office, owns 100 shares of the stock of Cameron. He has no responsibilities with respect to the Cameron audit. The firm's independence is impaired. As a partner in the office of the lead auditor, Phoenix, Johnson is a covered member and is prohibited from having, among other things, a direct investment in Cameron, even if it is immaterial. This is our last concept check question. The firm of McGraw & West CPAs has 2 offices, one in Phoenix and one in San Diego. The firm has audited the Cameron Corporation out of its Phoenix office for the past 5 years. Gizmo, a partner in the San Diego office, owns 600 shares of the stock of Cameron. He has no responsibilities with respect to the Cameron audit. The firm's independence is not impaired. As a partner in an office other than that of the lead auditor, Gizmo's investment does not impair independence. Let's go over the consulting services prohibited by the Sarbanes-Oxley Act. To begin with, we have bookkeeping, actuarial services, financial systems design and implementation, appraisal or valuation services, internal audit outsourcing. This is when the CPA would perform the internal audit function for the client. That's now prohibited by Sarbanes-Oxley. Investment services, management functions or human resource services, legal services and expert services, and certain tax services. Here's a few other ethics rulings. Retaining client records may be considered an act discreditable to the profession. Contingent fees are allowable for clients unless a CPA provides an audit or review of the financial statements, a compilation of the financial statements expected to be used by a third party that does not disclose a lack of independence, and an examination of prospective financial information. Contingent fees are not allowed to prepare an original or amended tax return or claim for a tax refund. And note that all tax contingent fees are prohibited under PCAOB standards. And here are a few more ethics rulings. In regard to commissions and referral fees, as is the situation with contingent fees, such fees are only allowed for a non-attest client. Allowable commissions received must be disclosed to the client. CPAs may advertise as long as it is not false, misleading, or deceptive. A member in public practice shall not disclose any confidential client information without the specific consent of the client. Auditors cannot directly disclose illegal acts by the client unless they have a legal duty to do so. And finally, CPAs have confidential but not privileged communication with their clients. Attorneys and clergy have privileged communication.